Gold has always been more than just a shiny metal. It's a mirror reflecting fear, trust, and power. When people lose faith in paper money or governments, they turn to something that has outlived every empire. In America, gold has never lost its quiet influence. Even as the economy evolves, digital currencies emerge, and markets chase the next big innovation, gold remains the ultimate signal of safety. It waits patiently for the moments when the world starts to tremble. As 2030 approaches, experts across the United States are watching gold with renewed attention. The last decade has been unpredictable. Inflation surged beyond expectations, interest rates swung between extremes, and the global economy struggled to find stability after a chain of crises. People began to ask again, what truly holds value? And every time that question comes back, the answer seems to point toward gold. The US dollar, despite its strength, has weaknesses that gold quietly exposes. When the Federal Reserve prints more money or keeps rates too low for too long, the real purchasing power of the dollar slips. Gold doesn't care about interest rates or political speeches. It stands outside that system, holding its value when everything else feels uncertain. That's why in moments of inflation or instability, investors don't just buy gold, they seek protection through it. Analysts are beginning to agree on one thing. Gold is heading into a long-term upward trend toward 2030. Some predictions are cautious, expecting prices to climb to around $5,000 per ounce. Others are bold, suggesting the world might see prices soar above $7,000. A few even whisper of more dramatic numbers, $9,000 to $14,000 per ounce, if inflation and global tension spiral out of control. But no matter the figure, one message is clear. Gold's decade is not ending anytime soon. Behind these predictions lie the forces that shape gold's destiny. Interest rates, for example, play a crucial role. When real interest rates, that's the rate after adjusting for inflation, stay low or negative, gold becomes more attractive. Investors prefer to hold something solid when their savings earn little to nothing in banks. Then there's inflation itself. As living costs rise and currencies lose strength, gold often becomes a shield, a way to store the value that paper money can't keep. But gold's story isn't just financial, it's emotional and historical. Every generation rediscovers why humans trust it. In uncertain times, people crave something real, something they can touch. That feeling has never disappeared, even in an age of screens, algorithms, and digital assets. Central banks around the world are also feeling that instinct again. In recent years, they've been adding gold to their reserves, slowly moving away from complete reliance on the US dollar. This quiet shift signals a deeper truth. Even the institutions that print money know its limits. In the United States, private investors are also rediscovering gold. Not just the wealthy, but everyday citizens, people worried about retirement, about economic collapse, or simply about preserving what they've earned. Physical gold, once seen as old-fashioned, is now being purchased alongside digital assets and stocks. Younger generations who grew up online are realizing that while cryptocurrency can vanish in a market crash, a gold coin still shines the same way it did 1,000 years ago. Technology is also changing how gold is traded and stored. Digital platforms now allow investors to buy fractional ownership of real gold stored in secure vaults, combining ancient value with modern convenience. Yet, even as the methods change, the psychology stays the same. People buy gold not to get rich fast, but to feel safe when the world grows unstable. That feeling of safety, that deep human instinct to hold on to something real, is what gives gold its timeless strength. The next few years in America will test that instinct again. With growing national debt, political divisions, and global competition from rising economies, the U.S. faces a period of uncertainty. Each of these factors could fuel gold's rise. The higher the national debt climbs, the more pressure builds on the dollar. The more political and economic instability spreads, the stronger gold's position becomes. It's not that gold grows. It's that everything else weakens around it. Even major financial institutions that once dismissed gold as an outdated asset are changing their tone. Reports from global banks now describe gold as a strategic reserve, a necessary hedge in a volatile world. Hedge funds and institutional investors are adding it quietly to their portfolios. It's not speculation, it's insurance. And as more money flows into gold, the higher its long-term value climbs. The public narrative is also shifting. Media outlets that once focused solely on tech stocks and cryptocurrencies are now featuring discussions about gold's coming era. Economists call it the silent comeback, a movement happening slowly without headlines until it becomes impossible to ignore. And this time, the movement isn't driven by hype or panic, but by realism. People are beginning to accept that our economic system, no matter how advanced, still relies on human confidence. And when that confidence fades, gold takes the stage again. That's why in financial circles across New York, Chicago, and Los Angeles, there's a renewed respect for gold's simplicity. It doesn't need innovation. It doesn't need advertising. Its value lies in the one thing humanity keeps losing and finding again: trust. The irony is clear. The metal that powered ancient kingdoms may soon define the future of modern finance. By the time the decade turns to 2030, the American economy may look very different from what it is today. Automation, artificial intelligence, and new energy systems will reshape industries. Yet even with all these transformations, gold will remain one of the few constants. Its price will not just reflect supply and demand, it will reflect trust, fear, and the perception of stability in a digital and fragile world. The Federal Reserve will play a central role in how gold behaves. Every decision it makes, raising or lowering interest rates, printing new money, or tightening credit, echoes through the gold market. When rates rise too quickly, investors may temporarily move away from gold toward bonds and equities. But if those same policies trigger a recession or weaken the dollar, gold reclaims its dominance. It's a delicate dance, one that has repeated across generations. Gold doesn't follow the economy, it waits for the economy to stumble. One of the most fascinating trends heading into 2030 is the global shift away from dollar dependence. Countries like China, Russia, and even several in the Middle East are exploring trade systems that bypass the US dollar. At the same time, they're increasing their gold reserves. It's a strategic move, a hedge against the dominance of a single currency. For the United States, this means a slow but steady change in the world's financial order. If the dollar weakens as the global reserve standard, the value of gold, measured in dollars, could rise sharply. Meanwhile, digital currencies, both private and government-backed, are adding new layers of complexity. The rise of central bank digital currencies, or CBDCs, is meant to modernize money, making it faster and more traceable. But some investors see it as a double-edged sword, a system that could offer convenience but limit privacy. Gold, on the other hand, is the opposite. It is anonymous, physical, and outside government control. As more people become wary of financial surveillance, gold may become not only a hedge against inflation, but also a hedge against digital dependence itself. Beyond economics, psychology plays a deeper role. Humans have an emotional bond with gold. It glows, it lasts, and it feels eternal. In a world where everything from social media trends to tech companies rises and falls overnight, the permanence of gold is comforting. It's not a bet, it's a belief. That emotional connection is what drives millions of people, from Wall Street traders to small-town savers, to keep a portion of their wealth in gold. Environmental and mining technologies are also transforming how gold is sourced. Sustainable mining, recycling, and traceable gold initiatives are gaining momentum. Investors are becoming more conscious of where their gold comes from and how it affects the planet. This ethical awareness may shift demand from purely speculative buying to more responsible and transparent ownership. By 2030, we might see a market where digital certificates represent responsibly mined gold, an intersection of morality, technology, and timeless value. Some analysts warn of volatility ahead. If inflation stays under control and the economy grows steadily, gold's rise could slow. However, most scenarios suggest that such stability is unlikely to last. The global economy is deeply interconnected, and small disruptions can have massive ripple effects. Trade wars, resource shortages, or new geopolitical tensions can reignite gold's rally at any moment. In that sense, gold's strength lies not in economic certainty, but in the inevitability of uncertainty itself. For ordinary Americans, this period could redefine financial planning. The traditional advice of diversify your portfolio will take on a new meaning. Holding a percentage of gold, whether physically or digitally, will become not just a recommendation, but a form of insurance. People will begin to see gold not as an old relic, but as a modern necessity. A timeless anchor in a sea of financial experiments. By 2030, experts predict that gold could trade anywhere between $5,000 and $7,000 per ounce. Some even forecast it might reach higher if inflation remains high and interest rates fail to stabilize. But the exact number is less important than the story behind it. Every dollar added to the price represents a moment of doubt in paper systems and a moment of faith in something enduring. The interesting part is that gold's value doesn't rise because the metal changes, it rises because our perception does. When people feel secure, gold sleeps. When they worry, it wakes up. The coming decade looks like a time when gold will stay wide awake. Another key element is generational change. Younger investors, often skeptical of traditional banking, are starting to explore tangible assets. They might begin with cryptocurrencies, but many eventually land on gold. They see it as a form of independence, wealth that doesn't rely on electricity, servers, or passwords. As technology becomes more dominant, physical assets will feel increasingly rare, almost rebellious in their simplicity. Owning gold might become a quiet statement, a belief in something human, not digital. In the broader picture, gold will serve as a silent teacher. It reminds societies that wealth without trust is fragile. Governments can promise stability, markets can promise growth, but gold demands proof. It's not an investment that thrives on optimism, it thrives on realism. The world's financial system, despite its complexity, still bends to the same human emotions it always has: fear, greed, and hope. Gold sits right at the intersection of those emotions, capturing them all without saying a word. As 2030 draws near, the U.S. will likely continue to walk a tightrope between innovation and debt, confidence and doubt. Every decision made in Washington, from fiscal policy to foreign relations, will echo in the gold market. And while the nation debates interest rates, budgets, and elections, gold will keep doing what it always has, existing, waiting, reflecting our collective uncertainty back at us. There's a quiet irony in all of this. Humanity keeps searching for progress, for new ways to measure value, for faster, smarter, digital forms of money. Yet after centuries of revolutions, collapses, and inventions, we always return to gold. It doesn't change, because it doesn't have to. It's the one element that doesn't need trust. It creates it. And in a world racing toward complexity, that simple truth may become more valuable than ever.